Hi, this is jeng, and today we're going to be talking about multifamily financing and then an update on sort of where we are here, middle of September, on these five loan types. So, my background: born and raised in Houston, went to school in Austin at UT. I was a loan underwriter for essentially 8 years at G Capital. Past 5 years have been a mortgage broker, doing about 800 million in multifamily loans across 125 properties. And then I've invested in about 7,000 units. About 1,000 of those have sold. So right now in about 21 properties in DFW, Austin, and San Antonio. If you haven't signed up for our conference is coming up in about a month. These are essentially like the top 15, 20 guys that I listen to. And, for the price of admission, I think it's great. And one thing that will be unique is that there's only one ticket type, and it will be 6 hours of networking and 6 hours of speakers. So we're going to try to make it super interactive so that you can get to know not only the speakers, but then also the other attendees. So if you haven't signed up for that, that's a good one to go to. All right, so let's talk about what's going on right now. So this was the latest in collections for September, and I would say most of my properties that I'm invested in are sort of A minus to C plus, and they're probably about 90% collected. This is on a national basis, so you see September has continued to decline, right? So May was 88, 89, but then sort of July, August, September, it's trickling down about 0.5% to 1%. What I am seeing though is that in Texas, people are allowed to at least file for eviction and start sort of moving the ball on people who have been there in March, and people are still making their payments. So, I mean, in relation to pretty much every other asset class, apartments are doing very well in terms of collections. So let's start off with just sort of where multifamily financing is right now. And I like to use this chart because you can see everything in one slide. And so most people are going to start on the bank loan side, and this is going to be your recourse bank loan. This is going to be for deals that really aren't there yet, right? So you're going to have occupancy. It can be anywhere from 0 all the way up to 80, 85% on the recourse bank loan. And this is going to be for your new investors. And these have no minimum loan amount on the bank loan. As you get more and more experience, you're going to move over to Freddie Mac. SBL goes up from about $1 million to 7.5. Conventional starts at 7.5, goes up to how big you want to buy. And then, so the interesting right now is that Freddie Mac, SBL is fixed rate, but Freddie Mac conventional is a floating rate loan. And so they have fixed as well, but a lot of people are using their floating rate products. So we'll talk about that when we get to that slide. Fannie Mae, this is sort of the standard. This is what people have used. I know some investors, all they have is Fannie Mae loans, non-recourse, stabilized products. So 90% occupied or better. The biggest issue right now on Fannie is the yield maintenance penalty. So once you get above, I would say 6 million, it is harder to get the step down prepay. So yield maintenance is very expensive. It can be 10, 15% of the loan amount as a prepayment penalty in your underwriting. So when you go to sell the deal, if they do not assume the loan, you get that penalty, or you have to pay that penalty. Non-recourse bridge, this is really for deals where you need occupancy, the occupancy is under 90, or the current debt service, the current operations of the property can't sustain the debt service of the property. And what that means is, rents are way under market, and you're coming in doing a bunch of rehab, $5,000-$10,000 a door in rehab, and you're going to raise those rents to market. And so those rates are about the 5% range. Freddie on the small balance side is 3 to 4%, but then the conventional side for Freddie and Fannie are in that 2.5 to 3%. So that's a huge differentiator, sort of pre-COVID. Pre-COVID, you were really seeing people lock in the 4 to 4.5 range, and now you're seeing people at 2.5 to 3. So when you look at this chart, right, you got bank loans on the left, non-recourse bridge all the way on the right, and right in this middle, this Freddie Mac and Fannie Mae. These guys are dominating the market the last, I would say, 6 months. And so you can see in this chart, I thought this was super interesting. Just that in 2019, they did about 35 billion in volume in the second quarter. In 2020, where there was like no transactions, pretty much everything shut off, they did more volume. So that to me was just, a lot of that moved over to refi business, and anybody that had, bridge loan or somebody back out, like a lot of loans, a lot of lenders backed out of deals in March, April, May, and Fannie and Freddie came in and closed it. So this to me, I see as a positive in that you always, like, if you do not have lending for multifamily, then all of a sudden, it's very difficult to get deals done, and that creates higher cap rates. So, all right. So when you're looking at deals, this is probably the question I get the most is, informing your sponsorship group. So I give you, the $10 million deal. I give you the debt of $8 million. You raise the $2 million in equity, or you put the $2 million down yourself. How do you qualify for the deal? So the net worth needs to be greater than the loan amount. So you add up your group's net worth, and that needs to be greater than the loan amount. Post-close liquidity. So this is checking account, savings accounts, marketable securities, non-retirement. Then if it's greater than 10% of the loan amount, once you add it all up from your sponsors, then you're set on that. And then this last thing, prior multifamily experience. So if you go Fannie, Freddie, even non-recourse bridge, you need this prior multifamily experience. So this is somebody who, has invested in deals, signed on the deal is very important. I would say it's steps, right? So some people will say, well, does my limited partnership experience count for that? And I would say it helps a little bit, but not as much as if you signed on the loan. And then if you signed on the loan, it helps even more if you were the manager. So as you move up that stair step, the more experience you have, the better. Most of the time when you're putting these sponsorship groups together on the bottom, there's going to be a deal guy, experience guy, equity guy, balance sheet guy, and you are going to get paid correspondingly based on what you bring. So if you bring all four, you get all the equity, right? So if you take 20% of the deal as the override to the deal, then you need to be able to find the deal. You need to be able to sign on the deal. You need to either invest the money or raise the equity, and then you can qualify for the loan. But 95% of the deals I do are syndications, and so all this stuff does not come from one person. It comes from a combination of these four things. Getting the property, ownership, raising equity, and net worth, and post-close liquidity. All right, so let's start on the left-hand side. We said, recourse bank loan. Why do people use these, right? So this was a deal down in Houston. It was 95% occupied, but the investors who were trying to buy the deal had never done a Fannie Freddie loan. And so, but they were, had really good incomes. They were accountants and they were IT, good tax returns. So they ended up just doing a 5-year loan, 1-year IO, 25-year AM. And then a couple of years later, they sold the deal, and there was no prepayment penalty. It was recourse to them, which means essentially that if there was an issue with the property, that bank had to foreclose on it, they could have come back and gone after their personal balance sheet. So, but this loan works really well for first-time investors, and you can get up to 75% loan to cost. But I would say these banks right now have had more disruption in their ability to fund loans, because these guys don't just give multifamily loans. They give hotel loans, construction loans, office loans. Like, they do loans across the board. And so this, I say, they have pulled back, and they are extremely tight right now on the recourse bank side. These are priced over federal funds rate. So federal funds rate, at the height, July 2019 was 2.4, and the Fed has taken it down to essentially 0 to 25 basis points. So we've seen rates in about the 4% range, but ironically, that is still not lower than Fannie and Freddie. So recourse bank loans are sort of just if you need them and you want that prepayment flexibility. So I don't know if you guys, this weekend, Charlie with Madeira was talking about how, for every one of his deals, if, it was 70% occupied, Fannie and Freddie wouldn't do it. So he had to go out and find, bridge lenders out there. And if he needed to, he was willing to sign recourse, because it gave him the prepayment flexibility, so that once he fixed the deal, he could go out and refi to Fannie, or Freddie. So, all right, so let's talk about non-recourse Freddie. This is the second loan type. This, I would say, is as you move up and you go from $1 million to that $7 million range, $7.5 million range, that's where Freddie SBL works on the loan amount. So 1 million to $7.5 million on Freddie SBL. This is, it needs to be 90% occupied or higher. They can go up to 80%. They are not going to roll rehab into this deal, not into the loan. So non-recourse Freddie, no, SBL, no rehab. You can do a 5, 7, or 10 year. And, at the 5 year, you typically get 1 year IO, 7, you get 2, and 10 year, you get 3. And then they have a step down prepay. So, it's a percentage of the loan amount, and, it usually starts at 5%, goes all the way down to 1. And so this, I think, is a great loan for you. I mean, if I was buying properties, this is what I would use in that smaller range, because it gives you a lot of flexibility, and it takes a little bit longer than it takes a little bit longer than Fannie to get approved, but I think the loan terms are great. Interest rate is a little bit higher right now than Fannie, but overall a great loan. So here's some of the pros and cons. Let's talk about some of the cons. It is that it is subject to Freddie Mac approval. So you have to take it in and essentially wait 5 to 10 business days for approval with Freddie Mac. So I would build in a little bit more time on the contract. No rehab is rolled in, and the max in most markets is 6 million. So I think in all of Texas, like all the surrounding areas of DFW, it's 6 million. But then if you're in Dallas County, it's 7.5 million. So you just have to figure out where the deal is. We look it up by county, and that's how Freddie Mac determines if you can go up to that 7.5 million. But everything on the advantages side, I mean, is perfect. I mean, non-recourse, 80%, 1 to 3 years IO, low closing cost, and then step down prepay. I mean, I think that hits all the buckets. I mean, this is really to compete against those bank loans. It just takes longer. There's more paperwork. But other than that, once you get the loan, it's great. So this is, it's driven by 10-year treasury, right? So 10-year treasury has sort of been stuck at 70 basis points after COVID. And so your rates, they move a little bit, but not much. So we're seeing rates anywhere from probably like 3.5 to 4, depending on what type of loan product you get and sort of where it is. So this was a deal in DFW, 80% leverage, 125 step down, and it was 372 with the 3 years IO. If you didn't want any IO and you wanted yield maintenance, you could go down to 345. So yield maintenance is a higher prepayment penalty, but you get a lower interest rate. So, banks, they're either going to get paid at the beginning or the end. So if you want a lower interest rate, they'll give it to you, but then you'll have yield maintenance on the deal. So, all right. So now, as you're moving up, right? So a recourse bank loan, you could do a $500,000 recourse bank loan. Fannie and Freddie, they really start at $1 million. And then as you go above Freddie SBL, there's what we call sort of Freddie conventional. And so this was a loan that we did. It was, I think it was $30 million loan for a deal in Bedford. And, we got 75% LTV. We got 10-year loan term, 5 years IO. And then what was unique about this one is that Freddie has a floating rate product. So this one, it was LIBOR. LIBOR is about 20 basis points plus 278. So you're about 3% all in on it. And this is what's unique is that instead of dealing with yield maintenance, it was 12 months lockout, and then it went to 1% prepay. So for 9 years, you were floating, and then it went to 1% prepay, which gives you a ton of flexibility. So you can refi, you can sell the deal, and you only have 1%. So if this is a $30 million loan, you pay the $300,000 at close, and that's it. You're out of the deal. So you have no yield maintenance to deal with. And what you can do is you go out and buy a cap on LIBOR. So LIBOR right now is, let's say, 18 basis points. They aren't projecting it to hit 1%, I think, until like 2026, 2027. So if you look at a LIBOR forward curve, they essentially aren't projecting it to go up. So when you go to buy an interest rate cap, so you buy these interest rate caps at 3-year increments. So you buy a 3-year cap right now, and it's essentially like $30,000 or $40,000. And so they're transitioning. So this deal already closed, but in the next month or two, they're transitioning from LIBOR to SOFR, which is very similar. SOFR is about 10 basis points, but your all-in rate's going to be about 3% still. And you'll go out, buy a cap. I think the SOFR caps are going to be a little bit more expensive than LIBOR just because they're new and there's less competition, but those might be, let's say, $40,000. So you buy the cap, You can buy it at 50 basis points or 100 basis points for LIBOR, depending on what level of comfort you want. And then, you sort of build that into your closing cost of the deal. So I think we hit most of those. I would say, closing costs are higher than Fannie, right? You got your interest rate cap, legal's a little bit higher, and then everything's got to go to Freddie, right? So Freddie, I would say, is not as aggressive as Fannie. They want higher quality deals. So this is really going to be for sort of your A minus, B plus, maybe B minus deals. And it's going to be over 7.5 million. So I think as you get into bigger and bigger deals, this is going to be an option for a lot of people. And it's priced over LIBOR. Let's see. I would say the main thing is this prepay. And, we're seeing rates anywhere. Like if you go from 80% leverage or 125 debt service, 80% leverage and 125, it's about 3%. But then if you go down to 65% leverage, 135, you'll get to that 285 note rate because of the lower leverage. So you maybe save about 20 basis points on the spread if you go a little bit lower leverage right now. So, so we didn't really touch on this too much, but Fannie and Freddie, when they in March, they essentially came out and said, "Look, we don't know what's going to happen with COVID. Is anyone going to pay?" And they had all these restrictions. So they had 12 months of P&I, 12 months of taxes, real estate taxes, 12 months of insurance, 12 months of replacement reserves, and they dialed that back. And so right now it's 12 months P&I on Freddie SBL, and then 9 months P&I on your Freddie conventional. So that is something that you have to put up at close. So that's about 5% of the loan amount on these deals. And so most people are just raising this money and then, this is probably a portion of their rehab, right? So if you got $1 million rehab, some of it might be this reserve and the other portion you'll raise outside of it. So this was interesting. So every month Freddie comes out and says, all right, what loans are giving us trouble, right? Because what are we learning from this COVID? So about 1,200 loans are in forbearance. All right. So 5% of their total loans. And this actually went down in August for the first time since COVID. And 76% of these Freddie loans that are in forbearance are small balance. And, that I think a little bit of that goes to sort of the Freddie SBL stuff is typically B and C. Most of these are, 10, 15, maybe 50 unit deals. And it's just smaller properties. And a lot of these people who own these properties don't have, huge reserve to make up the property and make up the debt service if the property gets hit. And then within the loans that are in forbearance right now, the 10% are student housing and 12% are senior housing. And so, I would say these are a little bit trickier just with COVID right now. Those property types are having more issues. So you can see down here on the bottom, in terms of change in forbearance, you can see that it is decreasing versus, I think this is probably March or April, where the number for loans that were in forbearance increased significantly. But now it sort of has evened out. So that's a good sign on the Freddie side. All right. So now, we went through recourse bank loans. We talked Freddie SBL. We talked Freddie conventional. Now we're going to Fannie, right? And Fannie is sort of your standard, I would say, B and C lender. They will be aggressive on this stuff. And the categories that they have, they don't really have an SBL product, but from 1 to 6 million, those loans are about 50 to 70 basis points higher in interest rate. But once you get over $6 million in loan, the pricing gets significantly better. Leverage is good. Right now, they came back with the green program. So the green program can get you about 30 basis points off if you do, 15% water, 15% electric savings. And the big thing here is affordability. So if your property is affordable, it's sort of uncapped business, and Fannie Mae is going to give you a bigger discount, I would say, on the interest rate. Whereas if your property is sort of top of the market for that area, they're not going to give you much of an affordability discount. So here was a deal in Dallas. It was 172 units, 95% occupied. The rents were really just low. And the borrowers coming in, they were doing about $5,000 a door in rehab. So we wanted to come in and get the purchase price plus the rehab at 75%. And so Fannie allows you to do that. We got 12-year loan, 4 years IO, 30-year M after. The challenge is going to be it has a yield maintenance penalty. So, if they want to sell the property, let's say in year 3 or 4, then it's going to have to be assumed and put a supplemental loan or second loan on the property when that new acquisition comes in. And so this is what most people are using probably for B and C product. This was probably more of a C deal. And so, but after the rehab, it'll probably be in that C plus B minus area. So this is what a lot of people use, 80% loan to cost, 1 to 5 years IO. And, this is nice, it's assumable. And plus you as the owner, you can take a supplemental loan as well. So let's say you go in, do your rehab, raise the value of the property. You can come in and get a supplemental loan and take out your equity. Some of the issues, you need 90% occupied for the last 90 days, and you have a higher prepayment penalty, yield maintenance, and then it needs to hit that 125 cover on in-place cash flow. So that 125 cover is on a principal and interest basis, not just a IO basis. And so a lot of people the past 3 or 4 years have been using non-recourse Fannie fixed rate loans, and nobody expected interest rates to drop another 150 basis points. But Fannie's about to roll out a floating rate product. So when that comes out, it'll be competing versus Freddie. All right, this is a little bit fuzzier than I wanted to be, but rates right now on 10-year stuff is about 3%. On 12 years, about 320. And then if you get green, you're able to go down about 30 basis points from that. So you can lock in under 3% right now on Fannie Mae, which is nice. In terms of reserves, on the above 6 million, it's about 12 months P&I, and then under 6 million, it's 18 months P&I. But very similar. They're going to give you they're going to hold it for 9 months, and then once you hit a 125, they'll release it to you. In terms of Fannie, so they definitely don't give as much guidance on sort of what's going on with their book, but it's been pretty steady, right? So since June, it's about 1% of the total loans, so about $4 billion. Sort of spiked in July at 4.5, and now it's about 4.1 billion. So it's doing pretty well, but it doesn't segment it out, small balance versus big balance or larger balance and then green or anything like that. So, but that's what we're seeing right now. And all right, so we talked recourse bank, we did Freddie, now we did Fannie. Now this last one, non-recourse bridge. So this is really for people who are more experienced, probably 3, 4, or 5 deals in. They're taking a deal that maybe doesn't qualify for Fannie, either the occupancy is low or they want to come in and raise rent significantly. And so the deal just doesn't qualify. This is a deal in Dallas, 95% occupied, but it needed about 10,000 a door in rehab. And so instead of going the Fannie route and getting a little bit of the rehab rolled in, they went the non-recourse bridge, got all the rehab rolled in. And instead of raising about 10 million in equity, because the loan was higher, they raised only about 8 million. 3-year loan term, 3 years IO, floating rate. So the rate's about 5% and it floats with LIBOR, and then has a 1% prepay. So once they fix the property, improve it, get it leased up, then they'll be able to refi or sell the asset. I would say, so the minimum on these are $5 million, and it is higher closing costs. So it's about $50,000 for engineering, environmental, appraisal, and legal. And then you need more experience. So this is not your first time loan, or if it's under 5 million, this is where it gets tricky. So it's usually priced over LIBOR, but then if it goes over or under 5 million, so a lot of people come to us and say, hey, can I get a non-recourse bridge on 1 to 5 million? It's like, you can, but your all-in rate, like down at the bottom in example 2, you're probably gonna be 8, 9, 10% on your rate compared to over 5 million. So at GE Capital, there was, we did non-recourse bridge loans for people across all property types. And so our rate would be about 5%. But once you get, and we only had so much capacity, right? We might have 20 people all across the US. And so we just can't look at, $1 to $2 million deals. It's just too small. All right. So I'm going to stop there and see if you guys have any questions. Put it in the chat on what you've seen so far. I have about 10 questions that I received from from people who registered. So if you guys have any questions, put it in the chat, and then I'll start going through them based on what you've seen so far. All right, so I'll take the first question here. Let's see. Josie asked, what is the most important factor in order to qualify for my first multifamily loan? So this goes back to that sponsorship group slide, right? So obviously you have a deal because you're trying to qualify. So after that, it's really net worth and liquidity and multifamily experience. So you have to, let's say you already have the net worth and liquidity, you have to go out and find someone with multifamily experience to qualify for that loan. And so finding somebody who has already done deals in your market is probably the most important thing, because that person will be able to sign on the loan with you. And then you guys as a group, they look at the group and just make sure everyone checks the box. And so that multifamily experience card is very important. Someone who signed on Fannie and Freddie before, someone who has been in that market before will make a huge difference. All right, let's see. Clayton asks, how has current economic environment impacted agency loan approvals for first-time syndicators? I would say on the Fannie side, it hasn't really changed that much. I would say on the Freddie SBL side. So Freddie SBL used to be a little bit more lenient on first-time owners and would allow them to, get a non-recourse loan on their first deal. And now what we've seen is they are very particular on that. So they want someone who's local. They want someone who's having third-party property management. And then even with all that, they might actually reduce your leverage, right? So even if the deal has, let's say 125 or 130, 135 debt service coverage, then they aren't gonna they're not gonna give you full leverage. They might be at 70, 75% instead of the full 80%. So just more restrictive on the underwriting. All right, let's see. Shane asked, how do new multifamily investors, real estate investors, when they don't have a track record? So I think the question is, how do you get in really if you don't have a track record, Shane? And I would say you have to partner with somebody else who already has a track record, or just do a recourse bank loan, build up that experience over, let's say, 6 to 12 months, and then you can go out and start signing on Fannie and Freddie loans from there. Bijou asks, what is the best loan option for first-time syndicators? I would say that recourse bank loan and Freddie SBL, if it qualifies, those are the best ones for first-time syndicators. Kimberly asks, what does it look like for multifamily in 2021? So, I think everybody has seen collections do well. I mean, I think everyone's hoping for more stimulus at this point, because unemployment's really gone from, let's say, it spiked up to 16%, came down to 12, and then now it's probably 8% right now. But there's still that gap. Pre-COVID unemployment was 3.5% to 4%. So there's still that gap of 4% of unemployment. And so that's going to hurt multifamily. And I think what's happening is that, I think collections are going to be okay, right? So it's going to still be 95% collected. I think the challenge is going to be pushing rents. So I don't think many people are forecasting any rent growth in 2021. And then your vacancy might increase, right? So you might go from 95, 94, 93%, and you're not going to be able to push rents. So the combination of those two things is going to drive your NOI lower. And so 2021, I think, is going to be pretty rough. I think people are still going to buy deals. A lot of sellers are still selling deals right now. So DFW has more deals on the market right now than I would say even pre-COVID almost. So there's a ton of deals on the market right now. Bridget asks, what financial numbers should I ask the sponsor for before investing? So I think this is more sort of from the passive side. And, as a lender, I ask for really two things, current rent roll and T12, right? So the T12 is going to give you how the property is doing right now. And you can sort of underwrite that and compare that to the pro forma and say, all right, here's the T12. This is what the seller is doing. How am I getting from T12 to the pro forma? And does that make sense, right? And then from that pro forma, essentially, you're taking year one and going to year 5 how am I going to, increase revenue? How am I going to decrease expenses to improve the value of this property? And then I always like to look at the rent roll and just see sort of what makes up my property, right? Because the rent roll essentially is going to show you what leases the person signing at, what is that, if there's any tenant concentration, student concentration, anything like that I would want to be aware of. Jared asks, let's see, as a deal sponsor, how much do I need to invest in a deal? So when you're first starting, the more that you invest, the better, right? So because most limited partners are going to ask you this question. They're going to ask, how much cash are you investing in the deal? What you have to be careful with is if you're going to do multiple deals in a year, they're going to want you to invest at least the minimum, if not more. So Fannie and Freddie, they really want you to be at least 10% of the equity in cash as the deal sponsor group, right? So if you're doing a deal on your own, you got to put in the full 10%. But if you're doing it as a group, each person can put in 100,000 on the deal, and that'll be enough to get there. But as a deal sponsor, I probably would be at least the minimum, if not 2 times the minimum. Ashwin asks, why do sponsors take agency loans on value-add deals with a 5-year hold when there's a big prepayment penalty like yield maintenance? So before, there wasn't really much out there to get 75 to 80% leverage. And most people were okay taking the fixed rate. And Fannie was really the only game in town on the B and C stuff. So Freddie used to do more Class A, Class B deals, and they were lower leverage. So they were 65 to 70% leverage. So if you wanted to go 75, 80% loan to cost, the only way you could do that was with Fannie. And so that's why they ended up taking those. And so you're having to deal with the backside, right? So you raise less money up front, but you're having to pay a bigger prepay penalty on the back end. Bruce asks, what qualifies as prior multifamily experience? All right, so this is 5 units and above. This is you signing on the loan, you being the manager of that entity that owns that property. That qualifies as prior multifamily experience. And Fannie and Freddie really want similar experience. So if you're going to syndicate a 100 unit or 150 unit deal, they want you to have already signed on one of those deals before. And so it's sort of unfair because how do you do one deal if you can't do the first one? But so that's why you have to partner with other people in this game. And you slowly stair step your way up versus trying to go from 4 units or 2 units all the way up to 150 units. You have to take an in-between step or sign on someone else's loan to get that prior multifamily experience. James W., is an adjustable rate, floating rate loan more attractive now? So right now, Freddie's floating rate product on the conventional side is very attractive to me. And it should be more attractive to syndicators. But essentially what happens is you can get, let's say, a floating rate loan at 3% or a fixed rate loan right now at 3%. So in almost every book, you would take the fixed rate. But the big thing is the prepay penalty. So it costs a little bit more up front. You have to buy the interest rate cap. Your debt service might go up a little bit. It might go from 3% to 325 or 350 if interest rates go up. But when you go to exit, it's a 1% prepay. And that is significantly different than, let's say, yield maintenance. Yield maintenance is going to be 10, 15, 20% of the loan amount at close. So it's going to materially impact your returns as a LP. So got a couple more questions here. Lana asks, when do you think the P&I reserve will go away? What is needed for that to happen? So they put it in March, right? So they put in, it was about 10% of the loan amount, and then they reduced it down in July. So they saw like 3 or 4 months of good collections. And then, my guess is that they're going to need another 3 or 4 months of good collections. This like we saw the forbearances starting to trail off, right? So I think they need to see good collections, forbearances to trail off, and then they'll slowly release that. But think about it from the lender's perspective. From Fannie and Freddie's perspective, they have no competition right now. Everyone's coming to Fannie and Freddie. The interest rates are low. The IO is good. The leverage is good. And you're having to put up a little reserves, but they are still the best game in town. So until they start seeing competition from other banks, from other bridge lenders. They're like, why am I going to take off the reserves? So I think it would probably be next year, my guess is. But after we record this, there'll probably be an announcement in my email that they've released it. So that's my best guess, Lana. Let's see. Next question is, Ball asks, if you have a Fannie or Freddie loan on your balance sheet, it's performing well, how does it impact future deal? It impacts it a lot, actually. So it helps you qualify for your next deal, right? And so with every deal, you as the sponsor, you submit what's called a schedule of real estate. And so that schedule of real estate is going to basically, they're going to look at the debt service coverage, look at the LTV, and the better that is, the higher probability your deal gets approved at the terms that it went in at. So very important. Let's see, this next one. How are lenders calculating net worth? So this is everything. I mean, some people will put, gold that they have in their vault, but basically it's all your equity, right? So assets minus liabilities. So all your equity, all your retirement accounts, all your cash, all your equity in all property types that you have. I mean, if there's anything in there that makes up a material amount, like I don't want to see a business valued at $10 million and it's not making any money right now, right? Like it has to be reasonable. I would say that if you have stuff outside the US, they typically do not count that stuff. So most of the stuff has to be in the US and, reasonably that you're able to access those assets. Someone asked, is your 50% rule of thumb for expense ratios dependent on the market? I would say yes. So the 50% expense ratio, if your total revenue for the month is $100, most of the time your expenses, let's say on a B property, are $50. And then I would say C properties is probably 55%, A properties are 45%. So right in the middle. But then if you leave Texas and go to, let's say, Phoenix, and Phoenix, they have the same payroll, the same R&M, but the taxes are lower, the insurance is lower. And so what happens there is you might be at a 40% expense ratio. So I would look at, Ashwin, the market that you're in, look at the T12, and as you start underwriting more and more deals, I think you'll see sort of where those expenses should be. Let's see. Someone asked on the reserve requirements, will they be there for first-time sponsors? So the reserve requirements are essentially the same for everybody. They're looking at it on a property-by-property basis. So they're not going to put on more reserves. Okay, so Michael asked, what are the typical required reserves for bank loan? So before there was zero. I would say post-COVID now, it's very dependent on your liquidity. It's very dependent on the leverage, right? So if you go back to the reserve slide, if you're at 80% leverage, you're getting that full, let's say 12 to 18 months P&I. But if you go down to 65% leverage, then it's going to drop to 6 months, right? So I think the banks are going to be very similar. If you drop your leverage, then they're going to come off of that. All right. Actually missed this last question. Charles, when should I be asking for a term sheet? So most people, let's say a deal comes in, you underwrite it, you're like, all right, this seems pretty close. You talk to the listing broker, whisper price is 10 million. You're pretty close, 9.5. You tour the deal, everything looks good, and now you're about to submit an offer this week. Then I would say that's the time. You should reach out, get a term sheet at that point. We'll need T12 rent roll, offering memorandum, whisper price, and then we'll size it up and tell you, all right, this deal qualifies for Fannie Mae, Freddie Mac, Freddie SBL, or this is going to have to be a bridge loan. So we'll let you know that. And then you can take that term sheet, submit it with your sort of terms of the deal, LOI, and then get that into the agent's hand. So let's see. All right, so I did see some questions on this, but it was actually the wrong webinar. This was actually for tomorrow's webinar with Jeremy Roll. So if you guys are signed up for the conference, we're going to have a session with Jeremy Roll, and he's going to be talking about sort of investment philosophy and passive cash flow. So this was this is what I was going to share with them. And this is in terms of high growth markets. One of the questions that we saw was around, where should I be investing? And this actually, I took this off of Camden. Camden, I don't know, they own and manage like 50,000 units, and the markets, in terms of population and employment growth over the next 3 years, it's all the four cities really in Houston, Dallas, Austin. I think San Antonio is on here somewhere. Um, but in terms of population growth, employment growth, these in gray are right there. So Houston, Dallas, Austin, Atlanta, Phoenix. Um, those are the markets. Maybe Charlotte is in there, and Tampa, as you go down the list. So I think if I was going to invest in markets, those are the markets I'd be focused on. So these are the requirements. And I did want to touch on this. I mean, a lot of people are like, if Old Capital is a mortgage broker, how's that different than going direct to lenders? I would say a couple things. I would say we have all the options, right? So we can do any type of loan out there, whereas most of your direct lenders are going to have one type. Whether it's podcasts, conferences, speaker series, lunch and learns, our goal is really to help you win the deal and make you more educated than you are when you met us. Whereas most lenders out there are just going to quote deals for you. And if, as a direct lender, most of them have one type of loan they can do. So if, even if it doesn't make sense to do a recourse bank loan, or even if it doesn't make sense to do a Fannie Mae loan, they're going to tell you to do that loan because that's the only loan they have, right? So whereas we're going to look at the deal and say, all right, this is probably your best option based off what you want to do. And during the deal, we typically tour deals with people. We connect you to vendors throughout the multifamily space and really are a second set of eyes on your deal. And, I used to be a former underwriter, so pretty familiar with what the bank needs, even before they need it. And then post deal, we work with people. Like I have a call with sort of my probably 5 or 10 general partners a month, and just sort of go through what they're struggling with at their properties, and then connecting those general partners. Because in this world, I mean, it's sometimes lonely being a general partner out there, and so just having people to help you throughout the process. And then obviously the podcast, the conference, and then we started doing more exclusive sort of networking events for people on our team. And then we charge the same thing. So we charge 1% at close. Direct lenders, mortgage brokers, they charge 1% at close. So I would say this middle part, this sort of pre, during, and post deal support is really where we differentiate ourselves from a lot of other lenders out there. Another thing on the conference, and I would say if you're watching this later, subscribe to this channel. If you need help with term sheets or deal review, anything like that, definitely send me an email, T12 Rent Roll OM, and I will get it sized for you. So that's it for the presentation piece. Appreciate everyone joining.